I think what we should do today is start by kind of talking about the basics of cryptocurrency, like what technological innovations started this whole crazy thing off. And so I'll describe kind of the very basics of how proof of work actually works, which is kind of this underlying system that's permitted a lot of the cryptocurrencies we know today. And then I want to talk to you guys about something that is happening in cryptocurrency right now and sort of bears on the future of how this all plays out. And I think is kind of one of the most important questions for whether cryptocurrency will really be adopted and used in a useful way. And that has to do with sort of more of the economics and monetary policy element. It'll make sense when we get there, but basically, you know, as everyone has sort of realized with Bitcoin, you can come to consensus about who has how many coins, and that's really cool, and we'll talk about how that works in a moment. But then we kind of can't come to consensus about how much a coin is worth. And without being able to come to consensus about how much a coin is worth, it doesn't really work in the way that money works. And so that's kind of the problem that we're trying to solve, and there's actually like 100 teams or more out there trying to find a way to solve that right now. So that's kind of the cutting edge thing, and I'll tell you a bit about that puzzle and kind of how to think about it. So, okay, great. So, and this is different from the talk that I normally give, so I'm just going to treat this very informally. I'm going to go ahead and go through this explanation and just stop me and ask questions as we go. Like, don't think of this as a formal presentation. I'm just a dude explaining how a particular thing works, and you can stop and ask questions at any point. Okay, so there's this term blockchain, right? What is a blockchain? Well, you know, sort of non-answer is like, well, it's a chain of blocks. Okay, cool. Well, what does that mean? What is a block, and what does it mean for them to be in a chain, right? So people like to draw these diagrams where it's like, well, you have one block, and another block, and another block, and another block, and they are somehow linked together. Thus, you have a blockchain. Well, what does it mean? What is a block, and what do the links mean? So a block in a blockchain is essentially just a list of transactions, okay? And so each of these transactions, in its simplest form, in the case of Bitcoin at least, is saying, you know, someone sent some coins, some tokens to someone else, right? So you have like a sender and a receiver and amount, basically. And so the sort of challenge, the thing that was solved with what's called proof of work, which is how these blockchains fit together, is the challenge of how do you have a database that isn't controlled by any one party, right? You want a database that's somehow controlled by a bunch of people out on the internet who are sort of spontaneously coordinating to update it. So that, and why do you want that? What's the point of that? Well, the point of that is essentially, let's say that we have, you know, a new currency, Nevin coin, and I have a database on my computer that's, you know, accessible on the internet, so anyone can say, like, I send some Nevin coins to this other person. I'm like, okay, cool, like, update that database, or my computer updates the database. Well, then that means on any particular day of the week, I can be like, I'm just going to add a few Nevin coins for myself, right? And that would be very tempting to do, right? And if you have a database that's managing money, and someone is the owner of it, then it's tempting to add some for yourself. And so the idea of having this sort of distributed database, which I'll explain in a moment how this works, is like, well, if we can have a database where no particular party is in control of it, then we can sort of, you know, collectively track who has how many coins in a way where no one can fudge that ledger and say, well, let's just add some for myself or take away some from this other person. Okay, so let's talk about what mining is. So mining is called mining because of the fact that in the case of Bitcoin and many other cryptocurrencies, new coins are added to circulation every time there's a new block that gets added to a chain. So when you went from here to here, some new coins were, quote, mined, right? And of course, mining means like, you know, pulling a resource out of the ground or whatever. In this case, we're sort of like pulling the coins out of thin air, sort of creating them. And that's a big part of the incentive for these people who run these computers out on the internet to track the transactions. So there's kind of two sources of capital for them where they're getting paid to participate. And I'll explain how it works in a second. One is the new coins that are generated every block, where you're actually like, quote, mining the new coins. And then the other is sort of the coins that are offered to them by the people who want to do transactions. So if I want to send some coins to Henry, I would say like, okay, here's this transaction, some coins from Nevin to Henry. Also, here's like a little bit for whoever processes this transaction. And so if you look at all these transactions, they will include some fee that's been offered up to the computers that are processing the transactions. And you can actually choose how much you want that fee to be. You can say, I want to pay a high fee, or I want to pay a low fee, or I want to pay no fee. And all those people running all those computers out there that are sort of collectively updating this database, they'll choose which transactions they want to process. So if you offer a really high fee, they will definitely want to process your transaction. And if you offer a low fee or no fee, they might choose not to. And so there's kind of this market for transactions in terms of the fees. And so what this means is that actually, like with Bitcoin, if you guys are familiar with like the way that Bitcoin works, new coins are being added now. And eventually we'll get to 21 million coins, and then that's it. No more new coins are added at that point. And so at that point, the only incentive to do this transaction processing is from the transaction fees. And so in a sense, the word mining won't exactly make sense anymore, because we won't be like pulling new coins out of thin air. They'll just be like recycling of coins through transaction fees. Okay, but sort of how does this work on a more technical level? Basically what happens is, let's sort of describe how these get added up. So we have, let's say we have a block that exists that's at the end of the existing chain, and we want to create a new block, okay? So what's going to be happening here, there's this new hypothetical block. There's going to be a bunch of different computers out on the internet. We'll represent them as little boxes. And I'll draw 5 of them, but like in the case of Ethereum, which is a popular cryptocurrency platform, I think the number is somewhere on the order of like 30,000. So you have to imagine like right now, and keep in mind, this is all happening like right now, all over the world. So right now there's like something like 30,000 computers all around the world trying to like mine the next Ethereum block, okay? And what does it mean to mine a block? So basically what's happening is there are people out there who are saying, I want to send, a transaction. So there's these like transactions that are like happening out in the world, and they're being submitted to the network somehow. So this transaction makes it to this computer, and makes it to this computer, and makes it to this computer. Maybe it doesn't make it to these ones. So actually, it's not like when you submit a transaction, it necessarily makes it to all those 30,000 at once, in which it might make it to some of them. And so now let's say that we'll zoom in and focus on like what's happening with this particular miner. So it has these transactions. These people have sent a transaction. Going one layer deeper here, what is a transaction? Yes?
Yeah, why wouldn't all transactions be available to all computers?
That's a good question. So there are different like distributed network protocols that are used for different blockchain setups. And it could be that actually for some of them, approximately all transactions that have been submitted end up being available to all of the miners. But it's sort of just a question of like, let me put it this way. It's not necessary for the functioning of the system that all transactions necessarily make it to all computers in the same way as it's not necessarily the case that your transaction will get processed like this block. It could get processed like next block. It could be that you submit it and the fee is too low and it doesn't get processed for a few blocks, and so you resubmit it with a higher fee to get it processed. So actually it could be that in practice in some systems they're going to be like submitted to all the different miners, but I just don't actually know for a fact that that is how it works, so I won't claim that right now. Okay, but then what is a transaction? So basically, raise your hand if you understand or at least are familiar in passing with asymmetric key cryptography. We're kind of getting to the mathematical application here. Okay, so I'm going to explain on a very basic level how this part works. I unfortunately can't walk you through all the details. I would love to do that. So basically, asymmetric key cryptography is kind of how you can have password-controlled money. Okay, and what do I mean by that? Password-controlled money, that's where you have what's called a public key and a private key. Okay, so let's say you have some user here, and the user, it's kind of like having a username and a password, where maybe the user can tell the world, like, this is my public key. Everyone can know that, okay? But then the user also has a private key that they keep safe in their like locked box or whatever, okay? And the way that these keys fit together on a high level is that because of the way hash functions work, where you can there's sort of like a one-way function, you can do what's called signing a transaction with your private key, where you combine some data, which in this case is just going to be like a message saying, you know, I want to send some coins to this other key. You combine that with your private key, and you basically do this thing called signing a transaction, which is then checkable by others with your public key. They can tell that a message was signed with the private key that corresponds to that public key. And so because of that, that's why in cryptocurrency I can take coins that are like sort of controlled or like attached to my public key, and I can send them to someone else, but you can't send them to someone else because you don't have access to my private key. So my private key is what allows me to sort of tell the network that coins that are attached to my public key are allowed to be sent to someone else, okay? And so basically then these transactions are signed messages saying, send some coins from A to B, okay? And so these get submitted to these mining computers. And so then what's happening with mining? So mining is this interesting process where we have this new block that's being contemplated, and we have some transactions. And then there's one more piece of how a block works. In addition to the transactions, we also have what's called a nonce, which is just like some number, okay? And what is the point of this number? This number plays a very, very special role in how proof of work mining actually functions, where basically you take some information about how do I put this? Okay, so you're combining three things. You're combining, we have a nonce here, and then we have the sort of like final hash number from the previous block. This will make sense in a second. So you take you can sort of think of it as like the ID number of the previous block. You combine that with this list of transactions as sort of pure data, and then also with this number. And then all three of those together as a sort of string get run through a hash function. Raise your hand if you understand what a hash function is. Okay, so a hash function is essentially, how do I put this simply? A hash function is a one-way function, which means that if you have a bunch of different like strings, like numbers and letters or whatever, and you run them through a function, more than one string will end up outputting something on the other side of the function, right? There's some data lost, essentially. And that means that if you know this, you can't tell which of these actually created it, okay? So some data is lost in a one-way function. And there's sort of more to say about hash functions and why they're interesting, which I won't go into now. But basically, what this means is that if you have a hash function, you take some data, you run it through the function, and the thing that comes out the other side looks like gobbledygook. It looks completely different from what you put in, okay? And sort of the point of hash functions in this case, well, okay. What happens in the case of mining is that each of these mining computers is collecting transactions, and then what they're doing is they are guessing a number and then hashing the combination of the transactions, the previous block ID, and this number, and then checking, okay, if we take all of that and we hash that in the way that I'm describing, that gives us some output, some number of characters, and they're looking at the first some number of characters and asking, do they have a certain pattern, okay? Like for instance, does it start with like 3 zeros? It's like one way of thinking about it. And this could be whatever. It doesn't matter what the output string is of this hash. And if the answer is no, let's say it's 1 0, but then it's like 1 7, then it's like, okay, that's not what we wanted. We were looking for a nonce that would output a hash that had 3 zeros to start, okay? So it's like, okay, well, that didn't work. Let's randomly assign another nonce. Okay, just some random number. Okay, run the hash function again. Oh, that time we had 2 zeros, but then it was an 8. Okay, so that also didn't work. Okay, so when these computers, when we hear about like Bitcoin using like a zillion terawatts of energy every millisecond, that's because these computers are basically just guessing more and more numbers for this nonce, and then running this hash function to check, does it output the kind of hash that we want? Does it start with the right number? And so eventually, and all these computers are all doing this all at once. They're competing to mine the next block, okay? Why? Because they get paid some coins if they're the one to successfully mine the block. So keep in mind, this is happening right now, like 30,000 Ethereum computers all around the world, like spinning fans like crazy, trying many, many, many different numbers and hashing them over and over and over again until eventually one of them probabilistically will end up discovering, it's like, okay, let's try this number. It's like, bingo. And this happens very fast. It's like, it doesn't take that much computation to take all of this and hash it and check. And it's like, woohoo, we found one. We found one that actually works. It's like a winning lottery ticket is found every once in a while through these like mathematical functions. What happens then? So if you find one that works, then you can send that message out to all of these other mining computers and be like, guys, you can stop now. We found a successful sort of combination for this next block, okay? And it's very fast for them to check that, right? So they've been spending like all this crazy computational power trying to find one themselves. But then, as we saw, like checking that is like very, very fast. So this gets sent out to that network of other miners, and they're all like, yep, okay, you're right, you found it. Too bad for us, and now let's move on. So basically then at this point, we're like, all right, cool. This is the next block. And so we have sort of the output of that hash is kind of the final part of this block. Sorry, this marker is running out. And what's happening now? Well, now we're just trying to mine another block, right? So same thing happens all over again. So people now are submitting new transactions. This is getting filled up again. And the same thing's happening. Everyone is now guessing numbers for this new block. So they're taking the previous block's ID and these transactions and then random numbers that they're guessing in order to try to mine the next block. Okay, yes?
So you want to be a miner. Is there some strategy to it, or is everything probabilistic? Or is your only strategy to get the best hardware possible?
Basically, the strategy is to get the best hardware. You just want to be able to check more numbers than other people. Because yeah, it's basically, at least as far as I understand it, you're basically just randomly guessing numbers. Yeah. And so there's this, so what this means is that these systems are programmed to try to have it be that new blocks are processed every like certain amount of time. And so if more and more people pile onto this and start doing it, well then the blocks will be processed faster and faster because you have more computation going into it. It takes less and less time to find a number that will work and mine the block. And so the actual time in seconds gets shorter and shorter. Well, what do we do about that? The way that Bitcoin handles that is it says, okay, every once in a while, like let's say at the beginning, we were looking for three zeros or 3 numbers of a certain kind, and then these could be anything. If the blocks start to get too fast, the algorithm for like the Bitcoin mining software says, you know what, we're actually going to force you to find something that starts with 4 zeros, right? Well, that's harder to do. And so then that will sort of then extend the block time in seconds again until more and more computers pile on, and then you can extend that. Interesting side note, some of these, of the sort of types of hashes and so on can be sort of, you can search, you can do the random guessing faster via particular specialized hardware. And so some people have tried to create blockchain systems that specifically use algorithms that can't be sped up with specialized hardware so as to have mining be sort of more accessible to people with normal computers around the world, which is an interesting sort of arms race. So then let's kind of zoom out again and be like, well, so what's the point of this? So basically what this means is you have this database that gets updated every few minutes or every like 30 seconds in the case of Ethereum. And the way to think about it is that it's a read-only, it's an append-only database that is then, like we said, sort of managed by all these different computers around the world, such that once you add something to the chain, once this block gets mined, then it gets recorded by all these different computers all around the world, and you sort of can't take it back. It's just there kind of forever, unless like everyone shuts their computers off, but because of the economic incentives, that seems pretty unlikely, unless the value of these tokens goes completely to zero. And so that means that, like in the case of Bitcoin, if some transaction got mined, even like 5 years ago or whatever, it's just there. And so you can always go online and basically download that entire history of blocks from any one of these computers that's tracking the whole thing. And so that's basically how this fundamental technology works. And so then the idea there, right, is that then you can have there's sort of this idea that like, well, maybe we don't need sort of trusted banking institutions if we can just collectively as a crowd through these interesting cryptographic tricks manage a database that tracks who has how many money units, right? And okay, let me pause there and let's do some questions. So what about this didn't make sense? What can I explain to have this make more sense?
How do the transactions relate to the numbers?
How do they what?
The transactions relate to the numbers, like the coding and the different blocks.
How do the transactions relate to
these little numbers and the coding?
Like how do the transactions relate to like these numbers?
Yeah.
So the set of data that you are running through the hash function includes sort of the hash of the previous block and all of these transactions specified in plain text, and then also the number. And so you take all of that and you sort of smush it together into a string, and then you run that through the hash function. Yeah. And then of course there's also a part that I kind of glossed over, which is, we talked about these two keys, and when you submit a transaction, signing it with your private key, it's also the case that they're going to be checking each transaction to say, like, was that transaction actually authorized? And basically that's just looking at, was the transaction clearly signed by the private key that's attached to this public key? And then also, did the public key have a balance that was high enough to actually be able to make this transaction, right? So that's also being checked by these computers as they're processing transactions. Yeah?
In the case of Bitcoin, the figure of 21 million, is that like a permanent limit, or is that a plateau, or can you tell us more about that?
Yeah, it is a permanent limit. So basically the number of coins kind of asymptotes over time, right? So function kind of looks like this, and then once you get to 21 million, then that's it. And this is sort of part of, so now let's talk about the monetary angle of this a bit. So this is an interesting, this is kind of why, in a sense, the ideological people got excited about Bitcoin. There are some people that believe that a fixed money supply is the way to go. Why is that? The reason for that is basically that if you look at the history of money, there's this pattern where the governments and banks that manage money will issue more and more units over time. And if you have sort of some commodity or some currency where the market values it at a certain amount, let's say, it's sort of like $1 trillion worth of value or pounds worth of value, not denominated in that, but just like that's like how much people want that thing. And then you double the number of units, well then sort of the value of each unit is cut in half, right? It's kind of the basic pattern that tends to occur there. And so people don't like the idea that their money is losing its value over time. It'd be better if your money sort of kept the same amount of value over time. And so some people think that the way to do that is to have a sort of fixed money supply, where then the value will stay the same over time. And actually, if you have like an economy that's growing, where that monetary base is tracking more and more actual real value, but the number of units is staying the same, then actually the value of each unit should go up a little bit over time. And people like when the value of the things that they have goes up. And so that's why sort of people have been excited about Bitcoin from a monetary policy perspective. From my perspective, I think that there are kind of two issues with this. So one is that if it's too what's called deflationary, it's kind of is confusing. Inflation and deflation, it sort of sounds like inflation should mean the value is going up and deflation should mean the value is going down. The trick there is that inflation and deflation refer to prices, not the value of things. So if prices are inflating, that means like the value of the currency is going down. And if prices are deflating, that means the value of the currency is going up in terms of purchasing power. So you would call Bitcoin, if it were adopted, and then the value continued to go up, you would call that deflationary because prices would continue to go down. And so if something is too deflationary, then that can start to be a problem because then people just want to keep their money because they can see, well, I could buy a whole lot more like a year from now or a month from now. Why would I spend this money? I should just keep it. And so economic transactions can sort of slow down. And this can lead to sort of further deflation, right? The less people are buying, the more prices will tend to drop. And so you can have actually, in the worst case, a sort of spiral. That happens with like really, really intense deflation. Probably a little bit of deflation is not a big deal in the same way that like a little bit of inflation isn't too big a deal. But that's kind of a far out problem. The near-term problem with Bitcoin, from my perspective, in how money works, and this is something that everyone, so now we're kind of transitioning to a second thing that I wanted to talk about, is that if you have a deterministic or a relatively fixed supply, and then you have like varying demand, it's going up and down a lot, well then the price of each thing is also going to change up and down as demand sort of goes up and down in a crazy pattern. And that's what's happening with Bitcoin and cryptocurrencies generally right now, is that their supply is either like deterministically slowly growing, or in some cases it's like already leveled off, or like some coins are created with just a totally fixed supply. But then you have demand kind of going all over the place because we don't know. Is it valuable? Is it not? Are people going to use it? Are they not? And so the market's kind of like super excited and then like super bearish and whatever. And so then the prices are all over the place. And so then that means that it's totally impractical to use Bitcoin or something like it as a way to save your money. And it's also totally impractical to spend it and use it as a transactional currency, right? So why don't you want to save it? Well, because it could be worth like half as much, like a few days from now, potentially. And why don't you want to spend it? Well, if you're holding it, that's probably because you think the value is going to go up. At least right now, the people who hold Bitcoin, that's typically the reason they hold it. And so if you're sitting there thinking, well, should I buy this coffee with my Bitcoin? It's like, well, why would I spend my Bitcoin if I think that the value is going to go up? I'll spend my pounds to buy the coffee. And so that sort of means that like every purchasing decision in a currency that's fluctuating so much is kind of a combination of a purchasing decision and an investment decision, because you're like thinking about like, well, is it a good idea to spend this thing or not? And so it's sort of hilarious. Last year, I've been watching cryptocurrency for a long time. The popularity of Bitcoin went way up, but the popularity of Bitcoin as an actual transactional currency was sort of at an all-time low, because everyone was kind of finally relenting to like, okay, fine, it's going to be so volatile, it's not actually going to even out, this really won't work as a transactional currency. And so a lot of companies that had started accepting Bitcoin were like, you know what, screw it, like this is not actually that interesting, let's stop doing this. There's still a few that do, but when they receive the Bitcoin, they immediately convert it into some other currency because they don't really want to be speculating on Bitcoin themselves. So an interesting thing is happening because of this, which is that a lot of people in the cryptocurrency industry have sort of given up on cryptocurrency actually working like money and replacing money that we would normally use. And they've sort of given up on crypto being useful at all in the world. And have sort of concluded like, okay, maybe this was just like a fun sort of like penny stock, like speculative bubble type thing. And another contributor to this is that a lot of people created tokens last year that didn't really make any sense. There was this huge amount of interest in the space, and so lots of people created applications that came along with the token, really just so that there was kind of like a thing that people could speculate on. And so the industry right now kind of looks like a big scam because it kind of is, because so many different projects created tokens that were kind of BS. And so, yeah.
What does that mean, create a token?
Great question. Okay, so enter Ethereum. So Ethereum is really cool. How do I describe Ethereum? Ethereum is okay. So Ethereum is a blockchain that uses that same design, proof of work. It might change to a different design pretty soon that's faster, but it uses the same design now. So it's kind of a lot like Bitcoin, except the creator of Ethereum sort of thought, what if we had a blockchain like that, but instead of just allowing people to transact and send coins back and forth, what if we also allowed you to program bots that could run on the blockchain itself? Okay, so you can write code that can then be executed by all those mining computers in an autonomous way, and the bots can also control the tokens. Okay, and so what this means is that you can then you can have some tokens, you can send the tokens to a bot, and the bot can have some logic for what it does with the tokens. Like you could program a bot that's like, you send it the tokens, and then it just sends you the tokens back. Or you could have a bot that's like, you send it the tokens, and it divides them 10 ways, and then distributes them to like your roommates. So yeah, and so basically then what this meant, one thing that this meant was that now if you wanted to create a new cryptocurrency, instead of having to sort of create this new software package that you convince a bunch of miners out on the internet to pick up and start running, you could just actually upload sort of this bot code to the Ethereum blockchain and sort of state, we are creating a new currency, right? So we're creating like Nevin coin, and there are like 100 of them, period. And like I own them all. And then I can start like sending them around on with the Ethereum blockchain. And so that meant that the barrier to entry for creating a new cryptocurrency went way down, because now you didn't have to convince a bunch of miners, hey, there's this new coin, it's going to be worth a lot, you should start mining it, and like sort of do this like persuasion thing to like get the whole network started. There's just already the Ethereum network, and anyone can just upload some code, and then now all of a sudden there's a new currency that's represented on Ethereum. So on Ethereum there's like many different cryptocurrencies. The base one is called Ether, but then there's just, I don't know how many, there's hundreds, maybe thousands of other currencies that are implemented on top of Ethereum. And so people tried to sort of think about like, well, wow, this kind of opens up this whole new world. This means we can create what are called distributed apps, Okay, so applications that instead of sort of the normal like web application model is you have some server somewhere that's like maybe like hosted by Amazon, or maybe you're running it in your garage, and people ping that server when they like go to a URL, and that server then does some computation, like pulls some stuff out of a database, stitches together an HTML page, and like sends that over the wire for your browser to display. The idea behind a distributed app is, well, what if instead of a single server or like a single company that manages a cluster of servers, what if that storage and the logic of an application were run by all those miners, right? So that it's kind of this like sort of the idea is like this trustless thing where you know that like no one can tamper with the data on the server or the logic, and you can actually read the code and see like exactly how that application functions on the server side because it's part of this like open source distributed computing network. And so then this is a pretty interesting thing because it's like, well, what if you what if you could like take applications that that are potentially subject to fraud, where people have the incentive to kind of like manipulate things on the back end, and then run them on these sort of open distributed networks so that everyone could know that there's no fraud. Okay, and so one application of this that I do actually think is legitimate is what's called a prediction market. So a prediction market is basically just, it's a place where you can go kind of make bets about what's going to happen in the future. So like, we could make a bet about like, I don't know, whether I'm going to say the word cake before we leave this room, right? And let's say that we make that bet and we record that we've made that bet on a server that's hosted by you, okay? But then if we're doing that, and then there's some function to decide like who pays who, well, that's controlled by this person who could then decide, actually, I want to just like take the money, or I'm just going to say that he did say cake because like he's paying me to say that, or whatever, right? So there's sort of like fraud that can occur there. The idea is then if this is all running on a distributed computing network where you can like read the actual code, and there's sort of no way for anyone to change the code, and no one's in control of it, and if you can then somehow get the information about whether I said cake onto the blockchain so that it can be processed by the code, which is another problem in and of itself, then we can sort of enter into that like sort of financial betting relationship in a way where we have confidence that like the thing's going to be adjudicated fairly and there's not going to be any foul play. And so the kind of idea of a distributed app or like trustless applications is basically that. It's like, okay, we can sort of search for ways to take humans out of the loop to sort of remove instances of fraud or corruption, etc. And when I say that a lot of the things were BS, it's because when you look at a lot of the applications, it's sort of like there isn't really a trust problem there. Like probably people are fine trusting some service to handle, their like whatever content. I don't want to pick on any particular applications, but there were a lot that didn't make sense. And why did people create those apps that didn't make sense? Because of the fact that many of these apps would have some token that was sort of like the central means of payment inside of the system. And the tokens had a fluctuating value. And as everyone was getting excited about cryptocurrency last year, a lot of those token values were going up. And so everyone was thinking, I could create an app that does like this on the blockchain, and I'll sell my token, and then the value of the token will go up, and my investors will be happy, and I'll sell more tokens at a higher price, and we'll all make money, and it'll be great. And then eventually I'll launch my application based around the token, and people can use the token to pay for things. But a lot of them didn't make sense, unfortunately. So I think that there is a huge problem in the world that can actually be solved by cryptocurrency. So like I was saying a few minutes ago, a lot of people have given up on cryptocurrency really being particularly useful. Here's a way that I think it's going to be very useful. All right, so this is a photograph from Venezuela. Those are tomatoes. And that is how much cash, and this is as of like a month ago, you would have needed to buy those tomatoes. Why is that? It's because Venezuela is in a cycle of hyperinflation, where the money is losing its value sort of faster and faster, to the point where you need that much cash to buy those tomatoes, or that much cash to buy that roll of toilet paper, which is kind of crazy. And this is kind of when things go way off the deep end from a monetary policy perspective, when things are totally mismanaged. And so you can see, sort of IMF rates for Venezuela in terms of price inflation, something like 4 million% per year. I don't know how you could have that number be exactly accurate, but it's a really high number. But if you look at this list, there are a bunch of other countries where prices are going up in terms of their local currency still really fast every year, right? So like in the US, we talk about inflation being about 2% per year. And it's probably something similar here on average. And but then you look at these countries and there's like, a lot that are like 30 or 40%. And then those are kind of official numbers. If you look at numbers that are measured weekly in terms of the exchange rates with foreign currencies, we see even higher numbers. So like 284%, 179%, 128%. And that's the rate at which prices are going up per year, right? So imagine if like, the cost of I don't know, like a milkshake is like, 120% more at the end of the year. That's crazy, right? That means that if you have money in a bank account or money that you're storing in cash, it's losing its value that fast. And that really sucks. That means that it's just very hard to save money. And in these situations, the government will usually limit people from purchasing foreign currencies to try to save the money for various reasons. This might not apply to people in this room, but normally when I talk about these things, I'm talking to sort of people who are super into crypto. Interestingly, the rate at which cryptocurrencies have been losing their value is kind of equivalent recently. The market's been going down a lot. So if you look at, on the left, these are a bunch of popular cryptocurrencies and sort of how much of their value they've lost compared to the US dollar in 2018. And then you look at these fiat currencies. Actually, a lot of the worst fiat currencies are doing better than these cryptocurrencies. And so, as of last year, it was a bit hard for us to convey like what this problem felt like to people in the crypto world because they mostly live in developed parts of the world where they don't have these currency problems. But now they kind of have the experience of money losing its value that fast. And then, I have to tell them like, and now imagine that's your only money. And you had no option to trade out into anything else, and you would work really hard for that money, and you had to live on it, and it was going down that fast. Like that's what the experience is actually like for people in some parts of the world. And so then it's like, okay, well, is the solution cryptocurrency? Well, maybe, but maybe not. Like this is sort of what Bitcoin has looked like, right? It went up, but then it's gone down. If you had traded your inflationary currency for Bitcoin in December, well, maybe you would have lost more money holding the Bitcoin than holding your inflationary currency. And so it doesn't really seem like a way out of this. So why not Bitcoin? For people familiar with cryptocurrency, there's issues with the speed and transaction costs for Bitcoin, but really price volatility, I think, is the fundamental one. I think that if it's just a savings account, maybe you don't care that much about the speed and transaction costs. Also, those problems are being fixed by a bunch of projects like Hashgraph, as you guys have become aware, I'm sure. But so really, the thing that I think needs to be created is a stable cryptocurrency where the value stays like roughly the same over time, right? If you had that, and it was easy for people to get their hands on it in these different environments, okay, well then there's a way for them to save money. And interesting question whether they would start transacting in it. I actually think no, but that's for a bunch of different reasons. We can skip over that for now. So this screen that you're looking at right now is a live market between Ether, that currency we're talking about on Ethereum, and US dollars. And I'm just going to explain briefly what these different things mean. On the left here, this is what's called the order book, okay? And these are representing basically people who want to buy and sell Ether. And the reason this is changing around a bunch is that people are like adding orders and then the orders are in some cases being matched with each other and people are actually trading, okay? And so this chart here is really the thing I want to explain to you guys. If you can come to understand what this chart means, it's actually really, really cool. So this chart is a visual representation of the orders. The order book is kind of hard to understand if you're just looking at a bunch of numbers. The chart kind of allows you to visualize it. So basically, the current market price of Ether right now, it looks like, is $198.66. That's sort of the most recent price at which people have traded it back and forth on this exchange, okay? And what this represents is these are people who are, I always get this wrong, these are people who are willing to buy Ether for dollars, okay? And this is a cumulative graph. So let's see if I can zoom in. Oh yes, I can, great. So this line right here means that there's sort of that much Ether that people are willing to buy at this price, right? So on the bottom, this axis is price. Oh, and see how it's moving around? That's because people are changing what they're telling this website about how much they're willing to buy, or it's because the orders are actually being cleared and trades are happening. So people are willing to sort of buy this much at this price, and then the reason why there's this horizontal line here is that sort of no one is offering to buy Ether at any price here. But then there's some more offering to buy right there. That gives you that little bump, and then willing to buy right there, all these little bumps. And so this is sort of adding up to kind of like how much you could buy or how much you could sell actually, if you're willing to sell to all of these buyers who are willing to buy at these different prices, okay? And so then if we zoom out, we can see okay, there's someone who's willing to buy a lot at this price right here. That's why you see that big line right there. And there's, again, a bunch of people who are willing to buy a lot right around this price right here. And then it sort of stacks up. And this is called the market depth. The depth just sort of refers to how deep the liquidity pool is, or how much people are willing to buy. Okay. Then on the other side, we have the same thing, but in terms of people's willingness to sell. Okay. So you have people willing to sell at this price, this price, this price, and then again, this huge thing here is some person or a bunch of people who are willing to sell a bunch at that price. And then again, we have this big jump up here. So it's okay, someone has basically said, if the market price gets all the way up to this price, I'll sell a lot at this price. It looks like $205. And so this is kind of a representation of everyone's offers that are just sitting on the market waiting, saying, if the price moves this far, I'm willing to buy or I'm willing to sell at that price, okay? And so the type of order that you put on the market to sort of create this accumulated set of offers is called a limit order. And you're just saying, yeah, again, if someone's willing to trade with me at this price, this is how much I'd be willing to trade. And so then if you were to go on Coinbase and buy some Ether for US dollars or euros, what's happening in the background, they don't show this to you, but what's happening in the background is that money is being traded. Actually, it could be that it's trading directly with Coinbase, but ultimately you're clearing one of the orders on this market. And so that's why if you look at the Coinbase app, the price is changing all the time, is because the market is sort of shifting around. As someone comes and buys, okay, so another cool thing. So let's say we were a really high roller, we had lots of money, and we're we want to buy into Ether right now. We're going to put $10 million into Ether right now. We would come and we would end up, these are all the people willing to sell Ether. Maybe we would have to buy all of these Ether coins that are offered up to here, let's say. Let's say that was a $10 million buy, okay? So we actually paid different prices for our Ether as we were buying. We paid that price and then that price and then that price and then that price because we're buying up all the Ether, at the best price we can get it until eventually we've bought our $10 million worth of Ether. Well, that actually moves the market price. So the market price, right now is down at, whatever, 198. We would have bought all of this, and the market price would be up to, looks like, $201, okay? So if we actually went and bought that Ether right now, the market price would move. That is what actually causes these market prices to move back and forth, is people buying and selling and sort of taking those orders. And so then all the people who were willing to buy at these lower prices, they would see the price having moved up, and they'd be like, oh, the price is going up. Okay, now I'm only willing to transact at this higher price because the market has moved. The market has come to believe that the thing is worth more. And so when you see these prices going up and down, this chart is kind of confusing. I won't explain the candlestick chart right now. The reason why it's going up and down is because of buys and sells that are kind of moving the market back and forth. And so that's sort of fundamentally what's happening there. I hope that makes sense. I just find this really fascinating. The reason I'm explaining this is because, when we think about the price of Bitcoin being volatile, this is why. It's because this is how these markets work. And so it's useful to have this kind of mechanistic understanding of what's actually causing the prices to go up and down. Now, there's one more thing I'll mention, which is, so this is just one exchange. This is Coinbase Pro. It's like a sort of legitimate exchange in the US. But there are many, many, many different crypto exchanges out there. It's crazy how many crypto exchanges there are. I don't know how many there are, but there's like hundreds. And there's at least like 20 or so that are like very popular, that are used by people all over the world. And so there's this interesting thing that happens where, let's say that we went and we bought our $10 million worth of Ether on this exchange, and it moved the market price way up. Well, that only happened on that one exchange. So it could be that on all the other exchanges, the market price is still what it was a moment ago. And so now we have this interesting disparity where it's like, okay, the price went way up on this one exchange, and it's still lower on all these other exchanges. What happens? Well, it ends up being that they all sort of come into line. But why? How does that happen, and why does that happen? The reason why that happens is that people have sort of figured out, okay, well, if the price is really high here and really low here, well, I can make free money off of that because I can go buy it here and sell it here at the same time, right? So it's like you buy it for, whatever, 198, you sell it for 201, well, you just pocket the difference, right? And so, but the thing is that action of buying on the lower exchange and selling on the higher exchange, that causes the same movement pressure that we caused when we moved the price. So if a lot of people go buy on the exchange where it's low, that moves the market depth. It actually moves the price up, and then they sell it where it's high, that moves it down. There's still a gap, okay, so more people buy here and sell here, and they move until they're in line. And then there's no arbitrage that's available. And so now all the crypto exchanges have sort of come into line again. And this is constantly happening, where people will buy on one exchange, it will move the price a bit because they're not an arbitrager, they just wanted to buy some coins, and then the arbitragers bring the prices back into line. And that's how the price of Bitcoin and Ethereum and all these other coins stays the same across all those different exchanges all at once. Okay, so that is just some background. So now we can actually talk about what it would take to create a cryptocurrency that had a price that stayed the same. Okay, so here again, this is that market depth chart that we just talked about, and so now let's talk about this thing called a buy wall. So a buy wall is just where you have some market actor or a conglomerate of them who are willing to buy a huge amount of the currency at the same price, okay? Well, what's interesting about this? The thing that's interesting about this is that if you went onto a market that looked like this, and you sold, let's say from here, where my mouse is, to here, let's say that's $10 million worth. So let's say this person is willing to buy a total of $20 million worth at this price. If you were to then go sell them $10 million worth, well, then this whole thing would sort of move down because half of that order would have been cleared, but the market price actually wouldn't have moved, right? Because you hadn't sort of gotten through that whole order to the point where you would start taking orders at a different price, okay? And so if that buy wall is big enough that no one ever clears it, then the market price never can move down. You can never actually change that market price, okay? And the same thing can happen on the other side. This is called a sell wall. Why is it called this? Just because it looks like a wall on this chart, right? So if you have a sell wall, then if I come and I'm like buying, if I never actually buy that entire quantity and the market never buys that entire quantity, we can't push the price up. The price can never move. We just keep clearing at the same exact price, okay? And so there's this concept of an exchange rate peg, okay? Which is basically just means like a way of keeping the price of something the same against something else. And fundamentally, the way an exchange rate peg works is via having a really big buy wall and a really big sell wall together, okay? If you have a really big buy wall and also a really big sell wall, then no matter how much people come and buy and sell, if they don't ever actually buy up all the inventory you have, they can't move the price. And so if you have, and so this is commonly used by like smaller countries that want to peg their currency to some currency of a larger country, often like their main trade partner, where you can sort of think of this as just like if you have some new currency and there's sort of no established value of that currency, but you want it to be stable so that people can use it economically to transact, then you might want to fix the exchange rate between that currency and some existing currency that's already like nice and stable and entrenched and people have like a consensus about it. And so so you could like peg, we could create, Henry coin and we could peg it to the British pound. And as long as you have that really big buy wall and really big sell wall on the market between Henry coin and the British pound, then the price of Henry coin in British pounds can never move back and forth, right? Because we've sort of pinned it in place. And and you can do that, by the way, you can do that on just one exchange for the reason that we talked about before. As long as you hold the price the same on that one exchange, and then if other exchanges are at different prices, well then arbitrageurs will go do that thing where they buy low and sell high. But they can't move the price of this one because of that big buy wall and sell wall. It's sort of like held in place. And so instead of this happening, right, which is what happens in the case of Bitcoin, your exchange is held in the same place and the others are just pulled into line with it because it can't move. And so that way you can hold the price the same across all the different open markets between those two different currencies. And so I remember when I was a kid, I sort of thought that exchange rates were just like laws, where it's just like, we have said that the rate between this and this is thus and so, and everyone will transact in that way. And countries do actually try to do that sometimes, but that doesn't really work because there are all these like market forces in the world where people are like, yeah, we don't really think it's worth that much, so we'll like go trade on the side. We don't really care about your laws. This is the actual market rate. And so if a country wants to maintain an exchange rate, it actually has to do that via having this really big buy wall and really big sell wall, where people just can't move the market. And so as long as they have enough money, enough capital to actually maintain that buy and sell wall, then they can maintain the exchange rate peg. And this happens all over the world. And sometimes it works and sometimes it doesn't. And I want to talk a little bit about why it sometimes doesn't. So why do exchange rate pegs break? So if you've heard anything about exchange rate pegs, you'll know that sometimes they hold and sometimes they don't hold. Well, why is that? The basic reason is that sometimes the monetary authority that's trying to maintain the exchange rate peg doesn't actually have enough money to maintain that buy wall or sell wall. And so eventually they run out of capital, like the wall is like really big and then people are like trading a lot and then eventually it gets like really low and then eventually they're out and then it's just like Bitcoin, right? Then we're back to the case where we have like a market depth chart that's like this, and so as people are buying and selling, the price can move back and forth, and that's what it means when the peg is breaking. The thing is that, let's say we've created Henry coin, not to pick on Henry too much, and we're trying to peg it against the British pound. If we're in control of Henry coin, let's say it's happening via one of these bots on a blockchain, or maybe we're just printing paper notes, well, we can make as many of them as we want, right? And so on the sell wall side, where we're just like sort of selling new Henry coins, we will never run out, because if we run out, we can just make more, right? And so that's really never the problem, right? So if you're like a country that's creating a currency and pegging it to the pound, you'll never run out of your own currency. You can just make as many as you want. The problem is really on the buy wall side, right? Because on the buy wall side, you have to have enough of that other currency that you don't control, right? You can't just make pounds. And so then you basically have to make sure that you have enough pounds to always maintain a buy wall no matter how many people want to trade, right? No matter how many Henry coins people want to sell back for pounds. And so essentially, so in some cases, countries will implement an exchange rate peg with what's called like a currency board, where they will have like full reserves. They'll have like, for all of the like coins or like, units of their currency, they'll have capital to back it that's equal to that value, right? So that no matter how many people want to trade out of this, they always have capital to back it, and they can always maintain that buy wall. In that case, the peg won't break. But the thing is that that's not always how people do it. Sometimes they'll be like this value of the local currency, and then they'll only have this much capital available to back it. Why is that? Well, the idea is like, well, we don't really think that 100% of people are going to want to trade out of this currency all at once. Like, they're using the currency in the economy. There's just really no need for 100% of people to trade out. Let's say that, we think that only 30% of people would ever want to trade out at absolute most. And so we'll just maintain 30% reserves. And then that buy wall will always be big enough because no more than that percentage will want to trade out. And if that's true, and it's never the case that more than 30% want to trade out, well, then that's fine. And you can maintain that currency peg. But in the course of history, if you go study this, people are sometimes wrong about that. People sometimes think, oh, this is totally sufficient, it'll be fine. And then some crazy financial situation occurs where people all want to trade out of one currency into another because there's some way to make money in some other market, et cetera, et cetera. And exchange rate pegs end up breaking in those sorts of circumstances. And what does it mean for a peg to break? Well, it's like you had this Henry coin, you thought it was worth like a British pound, and then you look at the market one day and it's like, oh, it's only worth like a third of a British pound. Well, that sucks, right? And so if you're creating a pegged currency, you really want the peg to not break because it can violate everyone's expectations, and you can sort of decimate people's savings, and lots of bad things can happen. Okay, so I'm not going to go into all of the ways in which people are trying to create exchange rate pegs with cryptocurrencies, because it gets pretty complicated pretty quickly. But the thing I want to convey to you guys is just that up until not that long ago, a lot of the innovations in cryptocurrency have been sort of about the consensus question of how do we keep track of who has how many coins, where proof of work is sort of what we described earlier, what we started with. And that was great because it worked, right? Like so far, at least, it's been the case that we haven't had like a major snafu where all of a sudden like everyone loses consensus about who has how many bitcoins. The problem, of course, is that it's sort of slow and also energy intensive. And so there are other consensus algorithms that have been explored that are being implemented today that are faster and more efficient. And so a lot of the innovation has been sort of cryptographic or game theoretic in sort of managing that consensus of who has how many of something. But now the industry is furiously working on how much each coin is worth. That's like the new challenge, is how do you peg a cryptocurrency to existing currencies that are stable in value so that we can maintain consensus not just about who has how many coins, but how much each coin is worth, so that it actually works as a form of money. And so, like I mentioned earlier, there's like, I think nominally like 100 or more teams that are trying to solve this problem. We're one of them. There are like a smaller number of projects that look like really promising, and then a bunch that are like, it's probably not gonna work. But the industry has kind of come to think, well, maybe Bitcoin isn't the thing. Maybe the thing is actually a stable version of Bitcoin, something that has all these properties of Bitcoin that can be sent to anyone, anywhere, where at least in the future, like transactions can be basically instant and for free. You don't have to have banks involved, et cetera. But also the value stays stable, and so then it works as a form of money. And so investors have started to pour huge amounts of money investing into these stablecoin projects because they think, well, maybe this is the real cryptocurrency. Maybe this is like getting in on Bitcoin at the beginning, right? And anyone who bought Bitcoin very early on made a lot of money. And so I don't know what the exact numbers are, but like more than $200 million have been invested in projects like ours trying to create these price stable or value stable cryptocurrencies. And that's kind of the interesting frontier in cryptocurrency as money. So that is what I wanted to share with you guys. Happy to like go into questions and talk about any part of this that you guys are curious about. Yeah.
If you did want to edit a transaction in the blockchain, what would you have to do? Can you?
Like if you wanted to edit a transaction that had already happened,
Yeah.
you can't really. I mean, yeah.
Yeah, so if you want to edit, basically you can't edit transactions that other people made because you can't sign up for them. But what you can do is change around transactions in the history of the blockchain. But the problem is, if you wanted to do that a couple blocks back, you'd have to redo all the work to get to the current block, which is, if everyone's competing to make the new block, and it's like really hard to do that, then you have to make 3 in the time that someone makes 1. So it's just easy to do that. But if you gain more than half the computing power in the network, you can sort of in the limit produce blocks faster than the rest of the network. So you could. So that's why. But assuming no one gains that, then you'll be fine.
Yeah, and so practically speaking, if I like send you some money and I'm like, oh shoot, I didn't mean to do that, I can't like call a credit card company and have it reversed. I just have to convince you to send it back to me.
So the new algorithms that you mentioned, are they still very, very similar in principle?
So largely speaking, the new consensus mechanisms that are being explored are called proof of stake instead of proof of work. And proof of stake essentially, how do I put this? Instead of a system like this, you basically say all of the coin holders can sort of like vote to process transactions. So it's sort of like the more coins you have, sort of the more power you have in the network to like verify that transactions are legitimate. And you sort of have to do this thing called staking, where you're sort of like risking your coins by putting them up and saying like, we stand by this. And so then if those transactions are like invalidated, then you like stand to lose money. And so basically there's this set of economic incentives that supposedly means that you can sort of come to consensus without this sort of crazy like hash function guessing thing. And there are some systems out there that are running with it. A lot of people are skeptical about whether it actually works. It's kind of this open question about like, do all of the incentives actually mean that everyone will always, like validate the transactions in the right sort of way? Whereas proof of work has been tested now for like, almost a decade. Proof of stake is very new, and so it's still kind of considered an experiment. And there end up being arguments about like, well, people have the incentive to not defect, because if they defect from the system, then everyone will sort of see that the whole thing is a sham and like migrate away, and the value of their coins will be lost. And so that's kind of why you're saying, well, let's take the people who are the largest stakeholders and sort of force them to be the ones to validate the transactions, because they have the largest economic interest to sort of keep the whole thing kosher. Yeah, that's kind of the new avenue that's being explored.
So you talk about people like wanting to get in early on stablecoins.
Yeah.
Not the hopes that make like big returns like people did with Bitcoin.
Mm-hmm.
How is that going to be possible if it's a stablecoin?
Great question. Yeah. Yeah. No. It's a great question. So the answer is that what's the easiest way to put this? So with Bitcoin, as demand goes up, the price per coin goes up. With stablecoins, as demand goes up, the price stays the same, but the number of coins goes up. Okay? So you're like adding new coins to the system instead of increasing the price per coin. And so what that means is that, at least in some systems, you can sort of be a supporter early on, and then as the number of coins has to go up, you receive the new coins. So instead of your coins becoming more valuable, you get more coins. That's like one pattern. There's a there's some problems with that. Another way to think about it is that these systems, if they work, can potentially produce sort of some amount of revenue for the autonomous network. Yeah.
Could you say something maybe about the kind of people who who want to work with groups like you and where interested mathematicians might fit in and the kinds of problems they might like and where people here might be interested in a few years' time?
Yeah. So you mentioned that one thing you find interesting is that we're interested in artificial intelligence. That's true about our team. Some people that are on our team have worked with this group called the Machine Intelligence Research Institute, which is trying to figure out, this is a complicated thing, like how to create artificial intelligence that will sort of do what you say and not do things that you don't say. We know another group that has spun off from that organization that is working mathematically to try to create a consensus mechanism like this that's much, much better via essentially probability theory. I wish I could explain it. I haven't had the time to read their paper, so I can't explain it. But from a mathematical perspective, there's still an unsolved question about like what is the best and sort of most efficient way to have a database like this that updates and tracks these things. And so like Hashgraph is one possible answer to that. A lot of people think it's good. A lot of people are skeptical of it. If you look really closely at these systems, they all have sort of interesting different trade-offs. And so you know, like the people behind Hashgraph were mathematicians. What this means is that if you can figure out the right algorithms, like the right way mathematically to think about all this stuff, there's a huge amount of impact that you can have on the world because you could potentially like build the core infrastructure for the future monetary system. You could also make a lot of money if you play your cards right by creating that. And then I would say that in addition to that, in reasoning about these monetary innovations, some people try to do it via simulations. So they say, okay, we have this system, here are the rules of the system, let's run simulations under like different market conditions and see how this is going to behave. Personally, I'm a bit skeptical of that because you can never really guess how markets are going to behave in advance. It's like very, very hard. They're very, very complex phenomena. And so our perspective has been really, we should only sort of trust any conclusion we come to about our system if we can get to it analytically, where we can say like, under no circumstances, unless there's like a bug in the code, could you ever reach this state? And so that process of analysis ends up being a bit more mathematical in some cases. And then there's one more thing I want to mention here. If you create one of these monetary systems and it ends up representing like billions or trillions of pounds worth of value, there's an extreme incentive to hack that, right? Because if you hack it, you can maybe steal like a huge amount of that money all at once. And this has happened in many cases. So one thing that we are mortified of is that we would create this system and there'd be some bug in the code. And there are, you know, and so our CTO, we picked him because he has a background in formal verification of code, right? And like program analysis, which is, you know, that's a narrow field. There's like a lot you have to learn on top of like, you know, even like specialized mathematics, but people who have mathematical minds tend to do well in that area. And the best sort of application security people and formal verification engineers that are going into cryptocurrency are in many cases commanding salaries of like multiple millions of dollars per year because you have to get it right. It's so valuable. It's like worth it for projects to pay huge amounts of money to get the best people to actually make sure you don't have a bug, because if there is a bug, the whole thing could fall apart and like huge amounts of money could be stolen. So there's sort of this like intense need producing these kind of crazy salaries. And that's in part actually, from what we understand talking to people in the field, it's in part because, as I described before, crypto is kind of seen as a scam right now, because it kind of is. There are these some legitimate applications, but a lot of people in that field are like, you say crypto and that means currency to you. Crypto means cryptography, right? And you've sort of co-opted this technology and like made a bad name of it. And so a lot of them are just sitting there not wanting to go into the field. And so it makes it even harder to hire them. And that's another reason why these sort of insane salaries are occurring. So, okay, that's the last thing, the last category. Okay, sorry, so back to day-to-day. So our engineering team is working a lot on that problem, on basically building these like formal verification frameworks to basically do like proof checking and so on and make sure that our code does the thing that we think that it does. But then they're also working on like the technology itself. So we have these series of like smart contracts that run on Ethereum. And like right now they're building like an internal exchange. It actually kind of looks like the exchange that I showed you for our like test tokens so that we can like test all of the stuff live before we actually roll it out. Then we have our protocol team, which is the team that's thinking about like the economics of the exchange rate peg and all that stuff and like how the thing should like manage capital and all of that. And so they often will just like sit there around a table like all day, like, debating and processing some particular question, trying to like improve our understanding of it. And eventually like, I'll have like a meeting with them. They'll be like, all right, here's the conclusion, here's the argument. I'll be like, nice, got it. And then we have our like business development team, where they're typically like flying all around the world. Like I spent like a month in Asia, and like a couple of guys just were in Dubai and then Malta. I'm gonna go to Angola later today to like meet with one of our partners. Like we're just like all over the world trying to figure out like, okay, who really needs this and why, and like what partnerships can we set up, and how should we design the actual end user product for it to make sense to people and all that. So those people are just like crazy traveling. And then we have our like legal department that is trying to figure out like, is this legal? And if not, why not? And what can we do to make it legal? How do we comply with relevant laws? What are the laws in different jurisdictions? Like another thing is that like these systems are like, as soon as you turn it on, they're globally available. And so something that might be fine in the US is maybe not fine in the UK. And so there's this enormous problem of figuring out like, even just knowing whether the thing is okay in like all of the different countries around the world is this gargantuan task. There's a lot of legal uncertainty in the blockchain space. And so they're like, they're like on phone calls with other law firms, or they're like researching on the internet, where they're like talking back and forth, being like, well, maybe we could tweak the thing like this so that it'd be okay in this way. Yeah, there's a couple of other functions, but that's kind of like the core of, I guess one more thing is like marketing. So we've putting an enormous amount of effort into like making videos that explain the thing and sort of like promote the project. And we're like about to like release an actual website. Right now we kind of just have like a landing page and so on and so forth, because ultimately the code is kind of part of a cryptocurrency, but the whole like movement and like everyone's belief that it's real is like another big part of it really being a meaningful currency. And so we have to do this whole movement building exercise in addition to just writing the code. Yeah. Yeah.
It's kind of like a twofold question. So like initially, do you think it's valid that for like the general population to become trustworthy and like invest in cryptocurrencies, they kind of wanted to be backed by like a big known like bank or something, like Lloyds or Barclays? And then the second part of that would be, would those banks ever want to decentralize currency? Is that kind of like the
Yeah. I can answer this, but I've been talking a lot. Do you want to answer this?
Yeah, so would a bank ever want to decentralize a currency? I think that, so banks themselves may not want to actually decentralize a currency. I do think in a world where there is a decentralized currency, banks do still have a role to play. So I don't see like cryptocurrencies as competing with banks on that dimension. So like banks in general, like so one function they play is loans. And so like you can have banks which will like hold the currency and then loan it out. So I think banks and cryptocurrency will be sort of like go hand in hand. And then the role that crypto has to play, which is really useful, is that it can be used anywhere. So cryptocurrency will allow banks to sort of like extend their infrastructure into a bunch of different countries right now, which have like pretty pretty bad banking infrastructure. So I think banks will be fairly positive because it'll allow them to to operate in places where they currently can't for regulatory reasons and for just like kind of trust in the institutions in that area.
So to further that point, would you expect maybe a resistance from governments like is expanding because they lose a lot of control over how the currency is run in the country?
Yeah, I think it'll depend. So I think initially, so like take the UK as an example, because so the UK would probably not want to just like give up control of its currency, but it's also fairly well run. Like so the UK doesn't have problems with this. So when we're talking about governments like ceding control, it would be in countries where it's currently really poorly run. I do think that they would not want to give up the ability to control their currency, but in the beginning, I think cryptocurrency and the local currency will kind of, again, like the banking thing, go hand in hand, because initially a cryptocurrency won't be used as a means of exchange in those countries, because there's already just such a huge network effect that the fiat currency there has. So mostly people will be using it as like a store of value, and so they'll still be transacting with, they'll still be using the currency, and the government will still have control over that currency. And so what it's kind of doing is just giving the people there some stability that they can rely on, which will improve the economic situation there. And then I think the governments will be pretty well disposed to like an improved economic situation, but still maintaining control of their currency because it has the network effect and it's what people use to transact.
Yeah, and so like there could be an extreme case where a country eventually totally switches over, and in that case, it could be that the government is not happy with that. In some cases, governments will actually decide to like dollarize, where I think in like Panama and maybe I think it's Ecuador, they just use U.S. dollars, where they have less control. Because of that, they can't sort of do independent monetary policy, but then they have the benefit of the currency just being sort of stable by default all the time, which is like pretty good for your economy. And so it could be that countries actually actively decide to do this in some cases, or it could be that it happens organically in a way where the government is not happy with it and the central bank's not happy with it, but they sort of can't stop it. Who knows? But that's a very long way off, I think.
Well, what do you guys think of applications of blockchain outside of cryptocurrency? Like I'm thinking like Walmart using it to track all of their produce. I don't know if you've heard of that.
Yeah, I don't know too much about that sort of thing. I've heard the general arguments for it. I think so. Blockchain outside of cryptocurrency, in general, I think it's not going to be that useful. I think that's actually one of the use cases where it's really good. So just for a little bit of background, my understanding of this is that there's this long chain of production from getting some product, like food. There's like a farmer or there are people who make the seeds, farmers that grow it. There's like a chain to get it to the stores, and then and that's kind of like obscured to customers. And if you use a blockchain, which sort of like cryptographically could prove every part of where some product has been, you can see the chain, and you can tell, like, if you really care about it being organic, you could tell that every part of this is like sustainable and organic. I think that's a good use case. Nevin kind of mentioned this. Most use cases of blockchain, I think, just aren't that good, because what blockchain is essentially doing is saying, like, here's a way where you can trust something definitely without relying on a centralized party. So most use cases, just you can rely on that centralized party, and you don't need to like give decentralize the trust. So most use cases not that good, but I think this one is a good one because people are so incentivized to lie.
But then even in that case, there's the question of how do you get the information onto the chain, like into the database about where that vegetable was like warehoused and whether or not they had pesticides in the warehouse, where like those parties who are, if they're just submitting the data, well, how do you know that they're not lying, right? And so the question is like, yeah, okay, maybe there's no person who's managing the database who can change the information once it's there, but you still have to have some process by which the information gets there. And so this is what's like commonly sort of thought of as like the oracle problem. So an oracle in the blockchain world is like some mechanism for getting information about the world into the database in a way that is like either trustless or trustworthy. And so like we have to deal with this problem in our system because our system has to know what is the market price of the reserve token, reserve coin, in terms of US dollars. That information has to come from somewhere. And so in our case, it comes from those crypto exchanges, right? Where there's trading happening, they have some information in their database, and then they have to, like either we have to have some computer out there that queries their API and gets that information and then submits it to the blockchain in a way that is actually hard to disrupt and is trustable, or the exchanges themselves, their computers have to directly post transactions to the blockchain that our thing can like cryptographically verify it came from them. And so if you want to go down that rabbit hole and understand kind of that question, there's kind of this new technology that's being explored there, which is pretty interesting, which is called like secure enclave computing. And the way that roughly works is you can have a computer that's running a set of hardware and software that can then basically cryptographically, I think it's sign packets of data that can then be sent over the internet, and then you can inspect the way that data was cryptographically signed and actually verify that a particular hardware and software stack was running on that computer and that it like wasn't compromised. And so that would mean that, like in our case, the idea is that these major exchanges, if they run this like SGX, like secure enclave type computer, then they can then have that computer submit a transaction to the Ethereum blockchain, to our smart contract, to our bot, and then our sort of code can tell that it came from them. They could still lie about the numbers they put into that computer, so you still have to trust them on that front, and that's why we would need like many different exchanges so that we sort of like make it so that it's really hard for them to fudge the numbers. But yeah, in general, like getting the information from off of the chain to on the chain is like a big problem that people are trying to solve in the industry.
Great. Well, thank you very much for coming. We appreciate it.
Yeah, thanks for having me. All right.